I'll pick you up right here. When you say growth at fair value, so what is the use case of your framework? Which kind of investor do you think this framework is most suited for?
See, I would not like to categorize which kind of investor, right? I would rather say which kind of markets, right? So if you look at it, last 2 years, the value style, so-called, which I believe in, has been doing very well. Prior to that 2 years, growth was doing very well. So I think this growth and value is a cliche. So what when you look at it, you want to identify buy companies who are doing good business. They have a good leg of growth over the next 2, 3, 4, 5 years, and their management is stable. On that, how do you overlay that valuation aspect, right? The margin of safety. So what I believe is, investors who are looking at value growth, idea is what the fund manager is doing over the cycles. And if the cycle is going against the value or theory of the fund manager, what corrective action it's taking. Like if you read my framework, which is clearly mentioned in our website, right? It says at times up to 30% of my portfolio can be in stocks which completely don't meet my framework. That means on terms of valuation, there is no margin of safety. The stock is very, very expensive. But if as a fund manager or as an analyst, I feel there are certain stocks inherently which something great is going for them and that can continue for a longer period of time, and though they are expensive and liquidity in the market is abundant and cheap, then it's prudent to have at least a benchmark weight in those stocks. So as investors, I would say markets are cyclical, but if the fund manager is sticking to his or her core philosophy, then at times you may underperform if the cycle is not right, but eventually you will get back. So that would be my answer to this question.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.